Hi, my name's Scott Dahl. Thank you for tuning in to another one of my podcasts. Today I'm recording on September 15th as the market's trading. It's currently 11:30 Pacific time. We're having a continued uptrend. The strongest thing the market can do is go higher, and that's what we're seeing. So we're seeing a very strong bull market compared to the early to mid 80s, compared to the 90s. I think that this has equal strength, if not more. What I've got up right now is a chart of the S&P 500, and you can see I've got two numbers here that I've put in. This 6570, that is the target off of this head and shoulders bottom. So what is a head and shoulders bottom? Well, what I did is I put up a simple diagram because I thought this could help explain it. A head and shoulders is a chart pattern that you see frequently at major tops, or you see them at bottoms. At the bottom, it would be called an inverse head and shoulders pattern. So the easiest way to explain this is up on the screen right now. This is a man here's his shoulder, here's his head, and here's the shoulder. So this is called a head and shoulders top. And if you reverse it, this is a head and shoulders bottom. So it's a man turned upside down. Here's the shoulder, here's the head, and here's the other shoulder. Now, I've simplified this. There are other factors that go into it, but I thought a good visual explanation would help us see it better on the chart pattern itself. Back to the S&P 500, here's the shoulder. This is an inverse head and shoulders pattern. Here's the shoulder, here's the head, here's the other shoulder. The other shoulder looks a little murky, but that's okay. This could be a double pattern. If you have a double shoulder on the right side, then that could create even a stronger move higher. So shoulder, head, shoulder. This is an inverse head and shoulders pattern. It measures up to 6,570. We're currently trading at 6,608. So I believe, and I stated this in August 7th podcast, I believe that we're traveling somewhere in this market between 6,570, which we've attained, and 6,807, which is about 200 S&P points away from here. Now, I did also state on the August 7th podcast that there's a possibility that we were going to see a sell-off because we had a bearish pattern here that is called a broadening top. And I said that if we take out these highs, then that would be an even more bullish sign, because if you negate a bearish pattern, a significant bearish pattern like this one, then I believe that shows even more strength in this market. So this is a very strong, very high momentum-based market. Those tend to run a long time and tend to be very strong. You're also hearing about the FOMO, fear of missing out, that if the market sells off, it'll be well supported because of the fear of missing out. I don't disagree with that. I think if we see sell-offs, fresh money will come into this market. However, FOMO, fear of missing out, that's when people buy as the market continues higher, and they don't wait for the sell-offs because they have that fear of missing out, and the general public has tendency to do the wrong thing at the wrong time. Here's why I wanted to address the market moves today, because there's talk coming out, are we in a bubble? And I wanted to take a look and address that. I don't believe we're in a bubble, and we don't necessarily have to reach bubble stage. We can. Fortunate thing about a bubble is it has a tendency to pop before you know it's there. However, let's look at that and see if this is a frothing market. So this is an interesting chart. I got this online. I figured why recreate it if I could just have it, and it's a very good visual. I'm not familiar with this company, Vetify Advisor Perspectives. However, this is where this particular chart came from. This is all the way back to, I believe this date is back to 1870, but this is the Standard & Poor's 500. This line through the middle here, it's a smooth trend. And what I mean by that is a fancy name for it is exponential regression. And it's just a way of giving a visual of the natural growth curve of the market. So it's the compounding path that it has a tendency to follow. And then we can use this path to measure the undervaluation and the overvaluation of the market. This is important because you can see that this is a little bit stale data, it's 2024, but we're currently at 187%. So right here, we were at 185%. So we're the most overvalued compared to the average return that we've seen in the S&P 500 ever. You go back here, you see at the peak in 2000, the dot-com bubble, we were at 108%. You see back here in 1966, 39%. 1929, we were at 77%. So it's the most overvalued ever. Also, please keep in mind that this data accounts for inflation. It's inflation adjusted. So what does this mean? This means that the price is very high compared to average returns. However, just because the price is high, that's not necessarily a negative sign. That does not connotate that we're headed toward a bubble. In fact, that could be a positive sign, because that would show that we have more momentum in this market. So price is not the only indicator. You want to look at sentiment. Now, also, I want to point out that the bubble in 2000, that was the dot-com bubble. There were companies that people were buying that had just come out. If they put a .com at the end of their name, it picked up investor interest. These were companies that didn't have any earnings, a lot of them, and there were companies that didn't have any projected earnings going forward. So people were buying stocks that really didn't show any potential. So that was an investor euphoria. In 1929, before the crash, people were actually buying and selling stocks on the street. Obviously, it wasn't an electronic market at the point. You had actual physical shares. So people were sitting on the streets, on the corners, and buying and selling shares from each other in the speculative euphoria. The people that perhaps didn't even really have the money to be doing this. In fact, I think that's where the term penny stock was coined back in the 1929 big bull market. So those are two examples of an extreme froth. People were buying assets that perhaps didn't really have any value. The difference today is that the companies that are driving this market, yes, it's a concentration. There are very few companies that are driving the S&P 500 higher, but they're well-established companies. They're companies that are hopefully harnessing this AI in order to profit from it, and they have profits. So it's a little different. It's not a little different. It's a pretty big difference from 2000 and 1929. So price is high, historically high. What else do we need to create a froth and to create a bubble? What we need this incredible euphoria that I had just described, and I don't see it. Now, if you look at what I've got up on the screen now, this is a AAII sentiment indicator. I put this up before. So it's a weekly poll, and it tells what investors feel is going to happen over the next 6 months. And so you can see that on September 10th, the green are the bulls. Here's the neutral, undecided. And then the red are the bears. So 49%, almost 50% of the polling, those people were bearish on the market. So when you have the general public that's bearish, that's a positive sign, because the public is typically wrong. The investing mass, the public is typically wrong. And if you go down here to the historical averages, historically, you've only got 31% bears. So we've got a very, very high number of bears in this market. And that would give me the indication, amongst other things, that we don't have a speculative froth right now. So I wouldn't rule out a sell-off. However, I would that's part of the mechanism, just like what we saw in April. They see sell-offs refresh, but I don't see a bubble at this point. And I do believe, if you look at my numbers, I do believe we're headed higher. I target a 6,800, and I think that we will head higher in this market. You want to buy dips. What you want to do is you want to make sure this is a momentum-based market, so you want to be in the strongest stuff within your risk tolerance, because that's what's going to make the most money. So give me a call if you have any questions. It's 949-497-6366. It's Scott at DowellCapitalAdvisors.com. This is called Dowell Capital Insights. Thanks for tuning in. I'll be looking forward to putting more of these up when I believe the situation warrants. Thank you very much.